For Jones Corporation, 500,000. Oops. We have the net income. That's 92.5 for Jones. Total assets is 500,000. And Smith, we have 52.5 as total income or net income, and total assets for Smith is 437.5. So to calculate return on assets, it's the same thing, net income divided by assets. Net income divided by assets. So let's go ahead and switch those as well to percentages. And again, you can see Jones is looking more profitable with the return on assets calculation as well. But we're still not done. We have return on equity as our next calculation. So let's take a look at return on equity. Net income to stockholders' equity. All right, so again, we have net income. It's 92.5 for Jones, and for Smith, it's 52.5. And stockholders' equity. So let's take a look at stockholders' equity. That would be for Smith corporations. There's a couple of different ways to calculate it, but we're going to go ahead and take a look here and just add up the stockholder equity accounts for Jones. We've got common stock of 150,000, paid in capital of 70,000, and retained earnings of 100,000. That's 320,000 for Jones. And for Smith, it's common stock of 75,000 plus paid in capital of 30,000 plus retained earnings of 47,500. And now, based on this information, we can calculate our return on equity for each, which is simply net income divided by shareholders' equity. This is net income divided by shareholders' equity. And you can see in this case, let's format these again. Cells, percentage. That return on equity shows the opposite effect. Okay. But we're not done yet. That's profitability. Okay. Now we're going to look at our asset utilization ratios. So this is receivables turnover. First for both companies. And receivables turnover is sales on credit divided by accounts receivable. Sales on credit divided by accounts receivable. So we need sales on credit divided by accounts receivable. Sales on credit for Jones Corporation, it's all on credit, 1,250,000, and accounts receivable for Jones Corporation is only 80. Smith, sales, all on credit, $1 million. And accounts receivable, 70. So let's take a look at their receivables turnover, which is simply sales on credit divided by accounts receivable. That tells you the number of times that this receivables balance is turned over during the course of the year. Okay, so we're going to do the same thing here. Looks like receivables is a little bit better managed here at Jones than it is at Smith. But we're not done with asset utilization ratios. We now have our average collection period. Which is our accounts receivable divided by average daily credit sales. Accounts receivable divided by average daily credit the average daily credit sales. So let's calculate let's find accounts receivable. And we also need to know average daily credit sales. Okay, so accounts receivable for Jones Corporation, Smith Jones Corporation, is 80,000. For Smith, it is 70,000. In average daily credit sales, we're going to go ahead and for Smith Corporation, it's going to be the amount of sales, which is 1 million. Oops, sorry, that's 1,250 divided by 365. And for Smith Corporation, it will be 1 million divided by 365. Oops. Let's try that again. It's 1 million 365. Now we can calculate our average collection period, which is going to be accounts receivable divided by average daily credit sales. So plus accounts receivable divided by average daily credit sales. This is plus accounts receivable divided by average daily credit sales. And you can see our collection period for Jones is a little bit better than our collection period for Smith. Now let's calculate inventory turnover, which is going to be the amount of sales that we have divided by our inventory. So for Jones Corporation has sales again of $1,250,000, and inventory, according to its balance sheet, is $50,000. And Smith has sales of $1 million and inventory of $75,000. To calculate our inventory turnover, we simply divide sales by inventory. And we divide sales by inventory. All right, so in this case, Jones has a